this presentation, I'll be presenting the gold and SPX switching strategy. Why are we interested in gold? Well, gold provides an uncorrelated alternative to stocks and bonds. Unlike stocks and bonds, gold is a tangible hard asset, and it has a limited supply, and demand is mostly constant or increasing over time, and it tends to have an upward drift over long time scales. As you can see from this graph here, this graph goes from 1975 to 2024, and there is most definitely an upward drift here. It also acts as a hedge against inflation and the devaluation of fiat currencies such as the US dollar, the euro, British pound, the yen, etc. And it's also considered a safe haven asset where it tends to rise during geopolitical events such as economic shocks and global conflicts. But is it really practical to buy and hold gold? I would say definitely not. This graph shows you why. This is a drawdown graph going from 1975 to 2024. And so you can see that from about 1980 to around 2006, there was a 27-year underwater period where gold was in a drawdown for all those years. And there was another long period from about 2012 to 2011 or so, or 2021, where it was 9 years underwater. And you can kind of see it from this graph here. So the first underwater period was from here to here, where if you had bought right here around 1980, it would have been dead money for 27 years. It wouldn't have even gotten back to the buy point until about 2006 or so. That's really unacceptable. And the other time was around 2012. If you had bought here, you wouldn't have gotten back to your original buy price until 2020 or so, around the COVID time. So not a very compelling argument for buying and holding gold, but it's a very good instrument to trade. So the next question that naturally comes up is, what if you use a trend following strategy on gold? So what I did here was I evaluated the rule where you want to hold if gold is in a 1-year trailing uptrend, and you want to be in cash if gold is in a 1-year trailing downtrend. So this graph here shows you the application of that rule. The gray line is the price of gold if you bought and held, and the orange line is the rule that's described here. So it most definitely keeps you out of those underwater periods a little better. Like for example here, just buying and holding around 1980, you go into an immediate drawdown for 27 years. But if you apply this rule, you don't actually go into a drawdown immediately. You make some money, but then it draws down over the next few decades. But then it comes back. So it mitigates the drawdown a little bit, but it doesn't look like something that you'd practically want to be trading over the long term. It doesn't even beat the buy and hold at the end. So we're going to need something better than a trend system if you want to be trading gold on this time scale. So that's where the gold and SPX switching strategy comes in. We can combine gold trading with the S&P 500 to improve performance. So what I do is I evaluate the following two rules at the end of every month. The first rule is we want to measure the relative strength between gold and the S&P 500. We want to look at the trailing performance of each asset and switch into the asset that has the stronger performance. And then we look at the risk-free rate. It's a filter where the selected asset from step one, it needs to be outperforming the 3-month treasury bill yield. If not, then we just invest in a money market instrument such as a CD or a money market mutual fund or an interest-bearing checking account or something. And this is the result of applying that timing rule. The orange line is These are all simulating what would have happened if I had invested $1,000 back in 1977. And the orange line shows you how that $1,000 would have grown over those decades. We'd be here. And the blue line is showing how $1,000 would have grown if you had invested in the S&P 500. And that's this growth right here. So you would have beaten gold, but you'd be here. And the black line is what would happen if you invested $1,000 in this switching rule that I just showed you. It would have grown like this. So it just beats the pants off of both the S&P and gold. And if you look at it on a shorter time frame, starting from 2000, and on a log scale, you can get more of a better look at the details of what's happening. So from 2000 to present day, gold has had a really good run, actually. It's the orange line. It's up here. Whereas the S&P 500, it's been pretty good over the past many years, but from 2000, it's endured two really bad bear markets, the .com and the subprime. And so it hasn't done as well. But then you look at the black line, which is the switching system, and it's more or less matched the performance of gold, but it's done so in a much smoother fashion. So, but obviously over the long term, going from 1977 to present day, the system just beats both of those assets by a huge margin. Here we have a comparison of the drawdowns of the two assets and the switching system. The orange area here is the underwater graph or the drawdown graph of gold, and the blue area is the S&P 500. And the black one is the one for the system. So we can see that the underwater graph of gold is horrific, basically. It's had a 60% drawdown, and the drawdowns lasted decades. And S&P has had a pretty bad drawdown as well during the subprime crisis, and the .com as well. And that one has been more than 50%. And here we contrast that with the black area, which is the drawdown graph of the system, which draws down a maximum of around 30% peak to valley. And we also note that the duration of the drawdowns in the system, they tend to be very much more brief than either of the underlying assets. So more brief and more shallow. That's what we want to see in an actively managed strategy. And here I've highlighted a couple of stress periods, the .com crisis and the subprime crisis, to show you how the system, the black line, performs during those times. So during .com, the system actually gained 7.2%. And during the subprime crisis, it gained 5.2%. How do you trade the system? Well, first you evaluate the rules at the end of every month and take a position in one of gold, S&P, or a money market fund. And the backtest is based on cash, which is unleveraged, gold and S&P 500, and it can be replicated using the ETFs GLD and SPY. If somebody wants 2x or double leverage, one can trade the ETFs called UGL and SSO, and those are the ProShares Ultra ETFs, which give 2x leverage. And if one is interested in doing options trading, these can obviously be traded with call options on GLD and SPY. And it's also tradable with futures, where you have the gold futures GC and the S&P E-mini futures ES. So in conclusion, the gold and S&P 500 index are both good long-term investments. But the buy and hold exposes you to extreme volatility and drawdowns, and so you need a more managed approach. The gold and SPX switching strategy provides exposure to both asset classes while keeping you invested in the one with the highest momentum, and has the added safety feature of moving you to money market if neither asset is having positive momentum. If you're interested in getting the exact investment rules for this strategy and the backtest spreadsheet, please go ahead and visit my website at this URL listed here. And I've also pasted this URL in the description box below. And that concludes my presentation for today. Thank you for watching.